From adult kids moving back home into $31,000 Flatpack studios to investors completely ignoring main centres to chase growth down south, the standard property playbook is being rewritten right before our eyes. Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. For this week in review, we're breaking down the 5 biggest stories you need to know this week. Stabilising landlord confidence, regional rental surges, pre-election housing policy proposals, the multi-generation backyard boom, and essential risk management advice for landlords. We've got a lot of ground to cover, so let's get started. First up, from the New Zealand Financial Advisor on the 22nd of July, investor confidence steadies but election jitters build. Independent economist Tony Alexander's latest monthly survey of 225 property investors for the Property Consortium indicates that landlord purchasing and selling intentions have stabilised following a prolonged downward trend. When balancing buying intentions against selling intentions, a net 23% of surveyed landlords are currently considering selling a property. An increasing number of investors state they plan to retain their properties for at least 10 years or never sell, suggesting that the recent multi-year drop in investor activity is reaching an end. Council rates and insurance premiums continue to be the primary cost concern for landlords, with inflation sitting at 4.1% and tenant availability easing slightly. More property owners are contemplating rent increases when possible. Investor unease is growing over potential changes to tenancy laws and tax deductibility ahead of the general election, leading mortgaged investor purchases to fall by 5.7%. Investor interest is increasingly concentrated outside main urban areas, with half of all respondents targeting just 4 regions: Canterbury, Queenstown Lakes, Bay of Plenty and Southland, which together account for under a quarter of New Zealand's population. Queenstown Lakes received 10.9% of investor interest, despite making up only 1% of the population, while Canterbury was the top choice overall at 26%. In contrast, Auckland underperformed relative to its size, drawing only 30.2% of votes, despite representing 34.1% of the population. When we look closely at Tony Alexander's newest survey, the core story isn't panic, it's stabilisation. After years of regulatory shifts, investor confidence has finally settled down. More property owners are committing to a decade-plus timeline or a forever hold, showing that experienced investors know how to look past short-term noise and ride out market cycles. It makes complete sense why mortgage buyer activity dropped 5.7% recently, as many people are approaching that wait-and-see method ahead of the election regarding interest deductibility and tenancy rules. And while that caution is understandable, while many buyers freeze, there's opportunities there for more educated or informed investors to take advantage of the current property market when banks are still willing to lend. The geographic shift is fascinating. Half of all surveyed investors are focusing on Canterbury, Queenstown Lakes, where the rental returns are shocking, Bay of Plenty and Southland. Queenstown pulled nearly 11% of interest despite holding just 1% of the national population. I wonder how much of the Queenstown properties purchased were sort of a dual use situation, like holiday home as well as short-term rental or something like that. And Canterbury took the top spot overall at 26%. Meanwhile, major centres like Auckland are lagging behind relative to their population base. The lesson here is simple. Look past nationwide headlines, analyse regional micro markets, and always ground your decisions in long-term numbers. For example, do you think that there's some property owners in Auckland who might be quite motivated to sell, since the property market's actually a lot slower here and there's a lot of business owners in Auckland? If you can make the numbers work, give it a crack. What have you got to lose? Worst thing that's going to happen is that the vendor will say no. Topic number 2 from Stuff on the 21st of July, property poll, where rent prices are falling and where they're still climbing. The Trade Me Rental Price Index shows that the national median weekly rent remained flat at $620 a week in June, showing no change from the previous month or year on year. And that's great news for tenants. Rental prices in main and North Island centres softened, with Auckland's median rent dropping 1.5% year on year to $660 a week, and Wellington declining 0.8% to $595 a week. Several South Island regions experienced strong annual growth, led by an 8% surge in Otago to $650 a week, matching Bay of Plenty, a 7% increase in Nelson, Tasman to $610, and a 5.5% rise in Canterbury to $580 a week. Despite an 11% seasonal drop in monthly search activity compared to May, tenant search engagement on Trade Me was 15% higher than in June of the previous year. New rental listings fell 2% month on month due to midwinter seasonality. Nobody likes moving house in the middle of winter, do they? So we do tend to find that rental activity slows down over the winter period, just like the sale property market as well. But it did remain 4% higher year on year, which helps to maintain a balanced supply and demand landscape. When headlines report that national rents have hit a complete plateau, it's easy to assume the rental market's cooling across the board. But when we look closer, that $620 a week national average reveals a dramatic regional divide. Major North Island hubs have eased slightly. As mentioned, Auckland slipped 1.5% to $660 a week, and Wellington dropped 0.8% to $595 a week. But look at the South Island. Otago rents increased 8% to $650 a week, matching the Bay of Plenty and closing in on Auckland as one of the country's costliest rental markets. Not great for tenants in the area, but if you can get a good purchase price on a property, that can be a pretty good rental return for you. Nelson and Tasman climbed 7% and Canterbury grew by 5.5%. What should reassure property owners is the underlying strength of that tenant demand. Search volume on Trade Me is up 15% year on year. And while we expect the usual 11% midwinter lull because nobody wants to haul boxes in the rain and cold weather, tenant engagement remains extremely solid. With supply up 4% year on year, the market is finding a good balance, and a stable rental market, just like a stable property market, is good for both sides of the equation. For landlords, a stable pricing environment provides predictability. If you price your property accurately and present a warm, well-maintained home, high-quality tenant interest still remains strong. Topic number 3 from a New Zealand advisor on the 22nd of July. NZ First reconsiders Crown co-ownership idea for first home buyers. NZ First is proposing a Crown co-investment housing initiative ahead of the general election to assist first home buyers. Under the proposal, the government would act as a joint equity owner alongside qualifying buyers to lower upfront entry costs, recovering its share when the home is eventually resold or bought out. Treasury officials previously resisted similar co-ownership concepts over concerns about placing speculative housing assets onto the government balance sheet. Kāinga Ora currently operates a similar shared equity program called the First Home Partner Scheme, which is fully allocated and closed to new applicants at the moment. Proponents suggest state banking could offer lower mortgage rates via Crown borrowing, though mortgage interest rates remain determined by commercial banks and the Reserve Bank's monetary policy rather than political parties. Commercial banks recently passed the Reserve Bank's 25 basis point official cash rate increase onto floating rates, but maintained their existing serviceability test rates. So my thoughts on this are, during an election cycle, politicians frequently roll out headline-grabbing housing proposals, but as smart buyers and investors, we all need to evaluate the practical mechanics rather than listening to the political noise. Shared ownership sounds great in theory, especially for buyers struggling to build a full deposit, but we already know how difficult these schemes can be to scale. Kāinga Ora First Home Partner program is completely full at the moment and closed to new applicants. Potentially not permanently, but But why is that? Because government funds aren't unlimited, and Treasury's always been hesitant to carry residential property risks on the balance sheet. Claims that political policies will deliver cheaper mortgage rates overlook the economic reality. Politicians don't set interest rates, although potentially they could with a shared home ownership scheme. Who knows what they'll do? But the Reserve Bank and global wholesale markets do set retail interest rates. What actually matters for buyers today is that bank serviceability test rates are held steady despite these floating rate hikes, and that preserves your actual borrowing capacity. Remember that the official cash rate, the OCR, that really only has the most impact on floating interest rates and the really short-term rates up to 12 or 18 months. The longer-term rates are determined by those wholesale swap rates. My message to first-time buyers is clear. Don't put your life on hold waiting for potential post-election policies that could take years to clear bureaucratic hurdles. Capitalise on current market conditions, steady pricing and strong inventory levels to purchase on your own terms, and talk to a mortgage advisor because you might be able to borrow more than you think you can, even if that involves low equity margins or lender's mortgage insurance. If you're getting value out of this podcast, please open up Apple Podcasts or Spotify app right now and hit that follow button. It's the number one way to help us help more first-time buyers and property investors gain access to quality content. And if you want to learn more about investing, join me at one of our free online events called How to Succeed with Property Investing, where we focus entirely on helping to increase your knowledge to reduce your risk. As a client of Property Apprentice, obviously you can call your coach or one of the financial advisors anytime you need help with no ongoing costs involved. As a financial advisor and experienced investor, I'll help you to navigate the current market with confidence and make smarter decisions. We're live, online and independent because we don't sell property. Go to propertyapprentice.co.nz to register for the next free event. Fourth topic for this week in review from One Roof on the 20th of July. What if the kids never move out? At Relate. Experts say Kiwi families should prepare for housing shake-up. High living expenses and student debt burdens are driving an increase in young adults choosing to live in backyard sleepouts, modular pods and granny flats. Statistics New Zealand data, or Stats New Zealand data, indicates that over 1/3 of households with children now include adult children living at home, marking a 27% increase over the past decade. And look, this is perfectly normal for this stage of the economic cycle that we've got as well. People do tend to move back home or delay decisions from leaving home when things are a bit tight financially. Property search filters on One Roof show that queries specified by land size have more than doubled over the past year, while searches for granny flats grew by 25% in 6 months. Government regulations enabling standalone dwellings up to 70 square metres to be built without a building consent have led to immediate interest, with Auckland Council recording 215 project information memorandum applications. Retailer Bunnings New Zealand has partnered with Elsewhere Pods to market Flatpack backyard studios starting at just over $31,000. Industry experts highlight that secondary dwellings are evolving into long-term, multi-generational living solutions, helping families support both young adult children and then potentially further down the track, once those adult kids finally move out, aging parents. Now, I'm saying this tongue-in-cheek because it's a standing joke in our house about how our 21-year-old daughter's still living at home. But to be fair, I'm very proud of her. She's saving to purchase her first home and taking advantage of the fact that she's got cool parents that she likes to live with. So other thoughts on this? The way that Kiwi families utilise residential property is undergoing a permanent transformation. The old expectation that adult kids move out somewhere around the age of 18 and immediately buy a home or go flatting for 5 to 10 years in their early 20s doesn't match current financial realities and student loan pressures. With over 1/3 of families now housing adult children, multi-generational living has shifted from a last resort to a strategic lifestyle choice. For property buyers and investors, this creates significant value opportunities. Search volume for larger sections, doubling on one roof, demonstrates that buyers are actively seeking properties with backyard potential. With new rules permitting standalone dwellings up to 70 square metres without a building consent, as long as it's a new build and separate from the main dwelling and a few other rule restrictions, constructing a minor dwelling has become far more accessible. However, my advice to property owners is to evaluate the full financial picture before you start. A $31,000 flat pack kit sounds affordable, but you still need to budget for site access, utility connections, plumbing, council requirements. Not to mention, if you're looking at renting it out to someone, it has to meet healthy home standards as well. When executed correctly, adding a minor dwelling can provide exceptional versatility, multi-generational flexibility, and long-term asset value. When it's not done properly, it can make your house less appealing to any future buyer. Topic number 5 from RNZ on the 20th of July, what landlords need to know if a rental property is used to cultivate cannabis. So this is, following on from what Paul and I talked about in the New Zealand Property Insights website. Police recently uncovered 17 properties in West Auckland being utilised as illegal indoor cannabis growing operations. The insurance industry data from AMI shows cannabis-related property claims have risen by approximately 17% over the last 5 years, while remaining relatively stable overall. Illegal indoor cultivation can cause extensive structural, electrical, and water damage to rental properties, including ruined ceilings, blacked out windows, dangerous wiring bypasses, which could potentially cause fires. Landlords are legally required to give proper notice before entering a property, even if they suspect abandonment. Repossessing a property through the tenancy tribunal requires formal applications supported by police reports and documented evidence. Landlords must follow strict statutory procedures when managing abandoned tenant possessions, including storing personal documents for 35 days before handing them to police and obtaining formal valuation or tribunal orders for the remaining goods. Insurers recommend specialised landlord insurance policies over standard homeowner policies, noting that cover typically requires documented quarterly property inspections and awareness of red flags like tampered power meters or cupboard windows. So my thoughts on this are, what a nightmare. Finding out that your property's been converted into a cannabis grow house or worse would have to be something that just about every landlord worries about at some stage. The structural damage from torn down ceilings and dangerous electrical bypasses to severe moisture issues can cost tens of thousands of dollars to remediate. What every property owner must remember is that you simply can't enter the home or throw a tenant belonging away without following the law. You have to strictly adhere to tenancy tribunal procedures for repossession. Take detailed before and after photos. So, particularly at the beginning of a tenancy, but during your tenancy as well when you're doing your inspections. You've got to secure formal police reports to support your insurance claim as well. Prevention and proactive risk management are your absolute best line of defence. First, make sure you carry a dedicated landlord insurance policy instead of just one of those standard homeowner policies. Even the ones with the insurance tack on are not the same as a dedicated landlord insurance policy. Second, check your policy terms. Most insurance providers strictly require documented quarterly inspections to maintain valid cover, and some of them specify that those quarterly inspections have to be done by a professional property manager. Grow operations don't appear overnight. Well, maybe they could, but generally not overnight. So completing pre-tenancy vetting carefully and performing regular quarterly inspections, keeping property lines visible from the street and watching for red flags like tampered power boxes, you safeguard both your tenants and your investment. And as Paul and I discussed, getting to know the neighbours of your rental property, getting their contact details, giving them your contact details can give you a really good early indication if something's a little bit off. I want to hear from you in the comments. With multi-generational living on the rise, regional rent splitting, and political housing proposals floating around this election year, are you looking at adding a backyard studio to your property or one of your rental properties? Or are you adjusting your portfolio strategy this year? Let me know your thoughts below. And if this breakdown gives you the clarity you need to navigate your mortgage and property plans this week, hit that subscribe button and give this video a like. Heck, while you're at it, tell your friends about it and let them know how to find us. If you want to discover how to build a highly resilient cash flowing property portfolio that can comfortably withstand any interest rate or regulatory cycle without the guesswork, join me at one of our free events called How to Succeed with Property Investing. Go to propertyapprentice.co.nz to secure a spot. And if you want to become a client of ours, we can help guide you through the process by holding your hand every step of the way with no expiry date. Thanks for listening. I'll see you in the next episode. Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.